Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix here alongside Paul Sweeney. This is Bloomberg Invest 2025. We are down here at the New York Financial District. This is where all the big names in finance, banking, asset managers, private credit, private equity, all come together and talk about the way forward. And part of that way forward is the policy that's going to come out of Washington, D.C., and any more insight we'll get on that on tonight's State of the Union with President Trump. So I want to go to D.C. with Nathan Dean. He's Bloomberg Intelligence Senior Policy Analyst. Nathan, there's so much to unpack here, but markets are down. Trade war's on. Does President Trump look at the stock market today?
No, I don't think so. I mean, I think President Trump, this is a long-term message from the White House in terms of these tariffs. Look, President Trump has been saying for months that tariffs are his favorite word, or maybe his fourth favorite word, depending on when he talks about it. But, and I think this was anticipated. I mean, everybody was thinking, is he going to do this? Is he not going to do this? But tariffs were going to come. It was just a matter of the size and the scope. Now, look, President Trump negotiates. That's what he does. There's always going to be a negotiation. But the response that we have seen from Ottawa and Mexico City today suggests that those negotiations aren't going to be taking place right away. This is going to need some time to cook. So I think what you're going to see tonight in this joint address to Congress is you're going to see President Trump double down on this idea of tariffs, an idea of bringing back manufacturing jobs to the United States. His Truth Social posts about farmers growing stuff in the United States to sell in the United States. That's the message that you're going to hear tonight. Wall Street probably isn't going to like that, but I don't think you're going to see any reaction from the White House in terms of Wall Street for a couple weeks at the earliest.
So, Nathan, what is the feeling in D.C. amongst, Congress, just the system, the bureaucracy about where this is all going here?
Yeah, so there's going to be a lot of unease, especially amongst the Republicans in terms of these tariffs. Senator Rand Paul even just tweeted 2 hours ago that, look, tariffs are going to increase prices, and he cited automobiles, that auto prices are going to go up as a result of these tariffs. Senator Grassley from Iowa, he's going to have a problem this tonight as well, because as President Trump says in the speech, look what I did in terms of the tariffs. Well, China put retaliatory tariffs on soybeans, and there's a lot of soybeans that go to China from the United States. So I think what's going to happen is over the next few days in terms of this Republican response is they're going to wait to see what happens. Now, Target and Best Buy have already said that price increases are probably going to be coming in the next few days. Is this enough to get President Trump to change his mind? Probably not. But as these farmers talk to folks like Senator Grassley, they're going to be saying, look, soybeans are down. We don't have a place to sell. So if you're not going to give us tariff relief, then you have to give us subsidies via a farm bill package. So there's a lot of unease negotiations that are going to be taking place between Congress and the White House over this tariff policy.
Which is what we heard from Justin Trudeau of Canada, saying we're going to support businesses that are going to be hit by these tariffs when he was speaking earlier today. So this all comes ahead of the State of the Union. Nathan, what's going to be, say, the top one or two things that you need to hear to help, make a policy decision, have conviction on where we're headed?
Yeah, so when it comes to tariffs in particular, I'm not exactly sure what look, we're going to be seeing if there's any nuggets that President Trump says in this speech that Canada and Mexico can come back with. Now, President Trump has always said this is about fentanyl. I'm not exactly sure if I believe that. The reason being is that, the Canada-Mexico agreement from 1 month ago, 10,000 troops on the border and so forth, Prime Minister Trudeau even just said this morning that, they've done that. What I need to see from President Trump is this idea of, is there any way that we could scale down the Canada and Mexico tariffs? Because if you remember over the weekend, Howard Lutnick was saying that potentially there's some flexibility here. And so I'm looking to see if there's any additional statements that he says that Mexico and Canada can do. But I also remind folks that on April 2nd, we have reciprocal tariffs. So if President Trump double downs and says, look, reciprocal tariffs are coming, I don't think you're going to see much of the way of this trade war ending anytime soon. The other thing that I think investors should pay attention to tonight is this tax reform debate. Because President Trump has said certain things like, look, I want to make these $4.5 trillion in tax cuts permanent, but at the same time, I don't want to touch Medicaid spending. So I want to see direction from President Trump towards Congress and specifically those House Republicans to see if he's going to put any leverage on them to support his goals there.
So what is the status of the tax package and the various economic packages? Because a lot of folks, Nathan, are telling me this is when the rubber's going to hit the road in terms of Democratic responses.
Yeah, so, in terms of this tax package, where we are is the House passed their budget resolution last week. Now, this wasn't a bill, this wasn't legislation, this was essentially a blueprint. And so what they said is, here, go forth, and this gave instructions to 8 House committees to go forth and look for $2 trillion worth of $2 trillion worth of deficit reductions to offset the $4.5 trillion in the tax cuts are going to cost. Now, there's economic growth, there's tariff money, and all of it should come approximately close. The challenge is that even though the House says that they want to get something done in April, if not May, the challenge is how are you going to pay for this, and how are you going to get the entire caucus on Creed? Because if you cut Medicaid, you've already lost several constituencies. If you increase the deficit, you lost others. So, Speaker Johnson has this really tricky situation of trying to get everybody on the same page. What we're telling our clients is, look, there's no deadline here that's going to force the House Republicans to come up with a solution until the end of the year. So they have all this year to figure it out. So we don't think this is going to happen until the fourth quarter. We do think a package will eventually come together. We do think we'll, extend these Trump-era tax cuts, but we don't think it's going to change the Inflation Reduction Act all that much. We probably don't think it's going to change Medicaid all that much, but again, it's hard to come up with specifics because they have the rest of the year to figure it out. It's just not going to happen in the time frame that they're currently saying it's going to.
Right, and that therein lies the issue for the market. So the stuff that's negatively impacting the markets, like tariffs, Trump can do on his own and have an immediate effect. But the stuff you're talking about, like tax cuts that can have a stimulative effect on the markets, can't be just done by President Trump, has to be done by Congress. So the longer that gap is, you have to wonder if it's going to be harder for the markets to digest.
Yeah, absolutely. So if you think about 2025 and think about catalysts, key things that are happening, right now we're going through the trade war. The trade war is probably the most important thing that's to the markets at this point because, look, we're seeing it in real time. We're seeing companies saying prices are going to go up. We're seeing the peso and the Canadian dollar go down. But then if you get longer term, we have a government shutdown coming up March 14th. Very little impact to markets. In fact, every single time this happens, we put out notes essentially saying there's no market impact from a government shutdown. Next after that, you have the debt ceiling. This is probably June, July. Obviously, if you're on the fixed income side, you care very much about the debt ceiling. We think there's an 80% chance the debt ceiling is resolved with. So we, again, don't think a lot of headline risk. We don't think there's really all that much to be concerned about. But then the next one is this tax reform debate. That takes place towards the end of this year. So this tariff argument in terms of market angst, this is going to continue throughout the year because ultimately it's President Trump's decision on when and if this trade war ends. And so there's a lot of uncertainties that are coming out from Washington right now.
All right, Nathan Dean, thank you so much. We appreciate that. Nathan Dean, a Bloomberg Intelligence Senior Policy Analyst.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We are at the Bloomberg Invest Conference 2025. We're down there in Lower Manhattan, World Financial Center, now known as Brookfield Place. A lot of smart people at this conference giving us the latest thoughts on what's going on in the world of global finance, including our next guest, Robert Rubin, Senior Counselor at Centerview Partners, 70th U.S. Secretary of the Treasury, and also former Senior Partner at Goldman Sachs. Bob, thanks so much for joining us here. There's a million topics we could go with you. But for better or worse, Bob, I think today is going to be known as Tariff Tuesday. When the tariffs hit, financial markets are really waking up over the last several days and weeks about what this could mean for our economy in terms of growth, in terms of inflation. How do you think about tariffs in general, and maybe how they're being used by this administration?
Yeah, I think tariffs are exactly what you just said. I think they create a very serious risk of inflation, not only because prices of imported goods will be higher, but domestic producers will be able to raise prices because their competitors' prices will be higher. But also, I think it's a substantial threat to growth because it can adversely affect productivity since you can no longer have access to whatever is the most efficient producer of goods and services. And as you can see from today's papers, there's a very serious risk of retaliation. More broadly, though, and that's a serious set of risks.
Right.
More broadly, I think there's the risk of a trade war. Mm-hmm. And trade war can be tremendously against this whole thing is against our self-interest. And there's one more aspect to it, though, that unfortunately has not gotten much focus, but should. We have treaty agreements with Canada and Mexico. We are now violating our commitments, our treaties. And what is that going to do to our credibility around the world? Not only with respect to economic issues, but geopolitical interests. This is massively against our self-interest.
At the heart of what the Trump administration is trying to do economically is pivot from fiscally funded economy to a privately funded economy, right? At the heart.
No.
You don't think that's true?
I have no idea what they're trying to do.
There is an argument to be made.
I'm not sure they know what they're trying to do.
But there's an argument to be made that that's what they prefer, right? Less fiscal stimulus and more private investment, and that's why they're trying to get...
No, but wait a second. You say less fiscal stimulus.
Yes.
Assuming that they get what they want in the reconciliation bill, that is to say, they get these large additional tax, or the continuation of the tax cuts, which would otherwise expire this year, that will substantially increase our deficits. The projections are that independently of them, deficit's going to continue to go up substantially, and with them, even more so. So I would say they're on a fiscally irresponsible and I think very dangerous path. Well, that's a continuation of conditions that have been. They're simply making them worse.
So you mentioned the debt, annual deficits. I've been on Wall Street since 1986. That's been a story since 1986. It's probably well before that. Is there a scenario where we really have to pay attention to these deficits?
I think we've been at that point for quite some time.
Okay.
But we're in new territory now. Roughly speaking, we're at historic highs in terms of the debt-GDP ratio. Mm-hmm. The CBO projects that they're going to go from the current 100% to about 120% 10 years from now. But that independent analysts, by looking at increased or likely increases in defense and interest costs, et cetera, think 130 to 135% is more likely. I think it is enormously dangerous, and the policies of this administration, at least as currently projected, are going to make that worse.
So how do we fix it? I mean, Ray Dalio said yesterday the debt crisis in 3 years could look like a heart attack.
Yeah, I saw Ray's comments. Yeah. I'm not sure exactly where he gets that from, but anyway. But I think, sort of conceptually, at least, he's right. With a heart attack, I'm not sure I would use that analogy. I'll tell you what I think is more likely than Ray's. Well, Ray is a very perceptive and astute observer. No, I think more likely is you'll have a higher interest rate, you'll have reduced business confidence, you'll have fewer resources for public investment and national security, and that will happen over time. The risk is that at some point it becomes what Ray just said, which is a fiscal crisis. The problem is, to deal with this, we can cut some expenses, but there's not that much to be cut. As a practical matter, it's very limited. What you predominantly need are more revenues, and the politics of that are terrible. This administration says the tariffs will give them more revenues. Two problems there. One is the tariffs will provide revenues, but at the same time they're going to adversely affect growth most likely. And if you look at models, and I have looked at models of this, the net effect is very small. And secondly, it is highly adverse with respect to growth and inflation. And as I said a moment ago, it means a violation, or that's what we're doing, a violation of treaty obligations, which then can affect our credibility around the world, which can affect us both geopolitically and economically.
Another pillar of this administration is immigration, getting maybe a stronger handle on immigration, legal and illegal, maybe even deporting some workers back. A lot of economists will say, well, that's not good for the economy either, because these folks are working, they're paying their Social Security taxes, they're doing jobs that Americans don't want to do. It's actually additive to the economy and keeping inflation down from wage inflation. How does that play into it? How do you view
I think
that?
you got it exactly right. If you look at the numbers over the last few years and you look at the growth we've had, which has been very good growth, some fair portion of that is because of immigration and the increase in the labor force. Furthermore, we've been having, on the legal immigration side, people of all skill levels, and a lot of very, very highly skilled people have come into, particularly tech, but also across our economy. The illegal immigrants are a more complicated question, but I think what you need to do is you need to approach that not from an ideological perspective, which I think is what's happening, but rather from an economic perspective and decide what, from a cost-benefit perspective, is in our self-interest. And the answer to that is going to be, I think at least, a substantial increase may be the wrong word, but a robust policy with respect to legal immigration, and then an approach to those who are illegals who are here that is based on the economic effects of what we do.
I am judging myself for asking you this question, but I feel like I have to, because this is what people are actually talking about in terms of Trump policy, and that's the Mar-a-Lago Accord idea, that potentially you'll see, a big deal among major economies to address the exchange rate and trade imbalances. So you can have a trade war and not have a stronger dollar, etc. Is anything like that something that you are listening to, talking about, like a Plaza Accord a la decades ago? Well,
a Plaza Accord was in a very different set of circumstances. I'm not sure what they're driving at, but whatever it is, I don't think they're going to get there this way. Aside from which, I think there's a lot of ideology about all of this. if you have trade deficits, and what's happening is you have an influx of capital, and then it goes into investment, that actually improves growth in the United States, and it's good for us. Now, if it goes into consumption, then eventually you build up, and if it goes into investment, then you have additional growth and you can pay back the debt. If it goes into consumption, then you don't have the growth and you don't be able to pay back, and over time that creates a problem. But whatever you want to do, you do not want to approach it through tariffs, and you don't want to approach it through browbeating other countries or taking advantage of what is a strong position of our economy. What you want to do is want to increase productivity in this country and increase savings.
AI, you told us offline that you've been really spending a lot of time trying to get educated on AI. We've got a full minute here. What do you think about AI?
No, I'll give you my views.
Okay.
About a year and a half ago, I thought to myself, AI looks to me like it's going to be really important. So about a year and a half ago, I started taking a tutorial. I go twice a week, an hour each time, and I don't profess any expertise in it, but I think I've become reasonably conversant with it. And I think it's going to change life as we know it, economically, geopolitically, and societally. And I think I don't think we're at all ready for all of the effects it can have.
What's an AI tutorial? Like what is it some guy at your desk going over stuff with you?
No, I'll tell you what it is. It's an extremely bright guy. We do it on Zoom. And he's taken me through the underpinnings. How does it work? And then what are the use cases? What effects does it have? And the more you get in, I would strongly recommend reading a book that's been recently published by Eric Schmidt and Henry Kissinger. And what they do is they go through what AI and what it is, but basically they go through the ramifications, the potential effects of AI. It's really enormously worth reading. This is going to change, in my opinion at least, have profound effects on pretty much everything we do over time.
Yep, that's what we're hearing from a lot of smart people as well. Robert Rubin, thank you so much for joining us. Really appreciate it. Robert Rubin, he's a senior counselor, Centerview Partners, 70th U.S. Secretary of Treasury, and of course, former senior partner at Goldman Sachs. We appreciate getting some of his time talking about some of these markets.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix, Sweeney, this is Bloomberg Intelligence Radio. We are broadcasting to you live from the New York Financial District with the Bloomberg Invest Conference 2025, bringing together financial leaders, asset managers, private wealth, private equity, as well as banking together to talk about the main issues of our time. And we have one of them here right with us. Mark Mahaney is Senior Managing Director at Evercore ISI. Perfect day to talk to you. NASDAQ 100 now below its 200-day moving average. The pressure not abating. What is in particular leading the tech part of the sell-off?
Maybe two things. One is that it's a sector with that's had phenomenal outperformance for the last 2.5 years. So in a reversion to the mean trade, you revert down the stocks that have outperformed the most. That's true. They've had phenomenal performance since the middle of 22, since interest rates stopped spiking. And then the second thing is, when the tariff issues, these are all, especially the tech leaders, are dramatically global companies. Half of their revenue or more comes from overseas. Amazon has doing a lot of retail, obviously, from China, but through Mexico and Canada. So anything sort of tariff issues would upend their business somewhat, depending on how well hedged they are, just as it would for any major retailer. So I think those two issues coming together are what's derailing those stocks right now.
Mark, you've been covering the tech sector for a long time. You were there at the beginning of the internet. A lot of people are comparing AI to the internet in terms of the ability to transform many aspects of life. How do you package that AI story for your clients these days?
I don't know if it will be that transformative, but the amount of money that's going into them, paid by companies, put in by companies that have plenty of cash, is something of a tell. And then we've seen a lot of examples of what I call ROAI, ROI, return on investment, ROAI. So, we're staring at it right now. Look at what's happened at Meta in the last 2.5 years, how they've turned around their business and and they've dramatically improved their services for customers. That's you and me as consumers. Our news feed has gotten to become more relevant because they've used AI to do better targeting, better recommendations, but also for advertisers. The return on ad spend spend, ROAS, has risen because the campaigns have become better targeted, better better managed. So I've seen a couple of really great ROAI examples, and so I'm not sure it's transformative, but it's definitely improving the performance of these companies, and it shows up in the P&L too. I think you can also look at Google. 25% of their code is now written by AI. Imagine the productivity improvement associated with that. And then Amazon is talking about 25% lower cost to serve in its most advanced distribution centers. I mean, that's why their margins are going to continue to go up. So you're seeing it in the P&L. So I think it's actually a major productivity improvement, and I think this is going to play out for years.
Okay. We do have some breaking news for you. This, according to the Wall Street Journal, that Ontario is going to issue a 25% export tax on electricity to the U.S. Canada, in particular, not only does it have oil, it has a lot of hydropower.
Yep.
So they're going to be taxing electricity to the U.S. Here we go. Okay, so back to AI and the transformative part of it and how it's going to trickle out through the economy. When do you think we're going to really understand how inferencing is going to impact us and companies? And like, when are you going to get me to buy in to an AI story?
Well, I tried to lay out a couple of examples already of where these companies are deploying AI and machine learning, and they have been for quite some time. We've just had a step up, like a hockey stick improvement. You just mentioned Canada, hockey stick inflection up in productivity gains because with these companies. So I'm sorry, I think we're already starting to see it, and I think we're seeing it in.
But do I see it? I mean, maybe my news feed, but will I pay for it?
Well, you want some really specific product examples. I got a really fun one for you.
Okay, into it.
You want to learn languages? There's this wonderful app called Duolingo. You want to really learn a language? Pay up for Duolingo Max, where you can use an AI-generated bot to actually practice your French, your Spanish, your German, your Russian, whatever we need to learn these days. Anyway, and I think you're going to see more of these kind of little one-off examples. But from a company's perspective, anything that produces internal productivity, improves relations with suppliers or customers. I mean, all of that's. I don't think there's one. I don't think there's one AI revenue build, but you'll see a couple of products that wouldn't exist, and I think Duolingo example is one that simply wouldn't exist if you didn't have AI.
How about for Google and the traditional search business? Is AI a threat to Google or not?
Google just put out a blog that said that because of AI overviews, that they're actually seeing more commercial search queries.
Really?
That should raise all of our eyes. So, and I guess I'm not, at the end of the day, not surprised. Google is a company that just consistently improved the product, made the search results faster and faster and more relevant. This just took that up a notch. And so, yeah, if they can get you the result you want more quickly, and especially if it's leading to more commercial searches, Google is the one company in the world that knows how to monetize commercial searches.
What do you think is the biggest misconception about AI, whether it's like what investors think, what's priced into the stock, or just conceptually?
I think the biggest misconception probably occurred about 3 weeks ago when DeepSeek came out, and there was concern that this would be highly disruptive for the hyperscalers. I actually took the exact opposite view, especially if you're at the application layer, because the infrastructure potentially just got a lot cheaper. So you're going to, all that money that you've spent on CapEx, you're going to get a better return. That money wasn't wasted. You're going to get a better return than you would have had in the past. So I think that's probably the biggest recent misconception I've seen.
For Meta, it's had a great turnaround, as you talked about. What percentage of that turnaround is simply cost cutting versus maybe just stepping away from the metaverse discussion somewhat?
I think it's 2 or 3 things. Stepping away from metaverse, focusing on the year of efficiency that Zuckerberg talked about at the beginning of 23, and now it's become the years of efficiency. And I think this does tie back into the AI. I mean, there has been a mind shift at Silicon Valley. It's not growth at all costs. There's much more of a focus on, so there's a cultural shift that I think is probably good. These companies are going through their middle life stages, not crisis, but stages. And as they do that, they should be spending much less aggressively on growth. They should be focused more on profitability than they are. But then the tie into AI is their developers can produce more code with fewer developers. It's not like they need to cut people from this point on, but they can grow. They can sustain growth with less need to add headcount than they did in the past.
All right, Mark, such a pleasure. Really, really great to see you in person.
Thank you.
Mark Mahaney, Senior Managing Director over at Evercore ISI.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
A happy Tuesday. Tough tape if you're looking at the equity market. We are live from the Bloomberg Invest Conference 2025. We have all the top minds in finance talking about the pressing issues, not only how to invest money, but the future of some of the significant things and the transition that we're going through, like, for example, AI. And here joining us on set is Bin Ren. He's founder and CEO of SigTech. Now, SigTech is a London-based fintech company spun out of Brevin Howard in 2019, and it basically tries to help quants and users manage the capital markets. I'm not really sure I know what that means, so luckily Bin is here for us. All right, so give us the quick pitch on what your company actually does.
SigTech, we build specialist AI agents these days to help people make better decisions in capital markets, but also to automate a lot of the very high-value intellectual but not very creative workflows. We can reduce a lot of the things people do today, which are a bit boring, down from many hours to 30 seconds. I think that makes a big difference in terms of productivities.
All right, here's an example that I can think of from my
tell me.
Being at the printer, not far from here, a couple blocks from here, Don Lilly, at the 2, 3 o'clock in the morning going over a bond prospectus. That's probably something that AI can help with. So, Ben, how much are asset managers, generally speaking, how much are they using technology today? How computerized is it? How quantitative is it?
I think in the last 15 years, there's a big trend in asset management to adopt more and more technology. And we can see this shift in terms of people using more data-driven investment processes, and people hire data analysts. And but Gen AI in the last few years is a big step change. I would say it's a unprecedented change in this trend. Just in terms of it's no longer incremental. There's a before and after. And when we think about previous technologies, we mainly focus on what we call explicit knowledge that we can codify, describe, and therefore use programming language to automate. But only until now, we are able to distill and automate so-called tacit knowledge, the knowledge that resides in our head, but we can't really so easily write it down and describe and codify. But now we can actually automate those, and there are plenty of those workflows and processes, especially in financial services.
So how would you help like a regular quant manager? Like, I go to you and I'm like, hey, I need your product to help me get better, faster, find better trends in the market.
Yeah, for quants, I think quants started with more number-driven. Trend following if you do it like in a very simple way, it's entirely number-driven. But these days, we are moving to a world where we have to deal with numbers and text as two modalities at the same time. It's no longer just about technical analysis, but it's also about absorbing new information and turn non-numerical information into numerical information. And that's something that Gen AI does really well. Because fundamentally, if you think about how it's trained, it has been trained on trillions of tokens of textual data. And a lot of things we used to do in a bespoke or proprietary fashion, these days we get out of box, such as sentiment analysis or extracting relevant information from very long pieces of text. These sort of things actually change how quants approach their daily jobs.
Are the big Wall Street firms making these investments, or is it more the hedge fund community that is more receptive? Who are your customers typically?
So these days we mainly focus on buy side.
Okay.
But we also have very big clients in terms of like commercial banks, using our technology to completely change how they underwrite commercial loans. I think so. I wouldn't say it's a sell side or buy side or big firm or small firm. I don't think that's the main reason in terms of adoption. I would say the main reason is the leadership. When you approach something so unprecedented, it takes some time to build a consensus inside your organization about what's the strategy, what do we do. But that may take 2 months, 3 months, and given how fast things change, after 3 months it's a different world.
Yeah.
Right. So it really takes some kind of a conviction from a visionary leadership team to adopt this technology very confidently.
Yeah. After 24 hours, it can be a different investing landscape. So what's the best partnership between AI and humans? 50-50? Is it AI 75% of the decision-making process, 25% for human? How do you think about that?
Yeah. I think if I think about the knowledge work we do every day, I would describe them as most of them maybe not creative, but intellectual, right? Analyzing a lot of documents, picking out the right information. It's intellectual, but it's not creative. So in the future, humans should devote almost all their time to creative stuff, what makes us different. Whereas the boring intellectual stuff can be automated by AI agents. On the other hand, we are certainly seeing a big change in the user experience, the user interface, because up to until this point, people approach Gen AI mainly through a chatbot. There's a chat box, you type into it, you get some response. It's very nice, and it's really started the era. But going forward, we are looking at a user interface that allow a human to essentially collaborate with a large number of AI agents who specialize in different things. So how does that user interface look like? And how does that AI-human fusion intelligence look like? It's a very active field of research, trial and errors.
So this sounds like, from what I understand of AI, a lot of computing power requirements. Talk about the investments that you think these financial firms need to make, are making, or maybe need to step up.
Yeah. In terms of intelligence, the way I think about it is it's very similar to electricity.
Okay.
So we are currently in the first stage of investing in the infrastructure. Right? And if you're going back in history, in the last 200 years, and the way we started building electricity grid, there's one magical number, which is 1%. The countries throughout the history spend about 1% of nominal GDP on building power grid, from 200 years ago in Britain all the way to today. So the big tech this year announced $300 billion of investment into Gen AI data centers. That's almost exactly 1% of the US GDP today. It's about 30 trillion. So in terms of infrastructure investment, we are there. And people are building incredibly big mega AI clusters across the country. Now, but we are shifting toward the application layer, right? Because once you have electricity, it's not about the electricity per se, it's about what kind of appliances you can build powered by electricity. So we are moving into that stage too, where there are a lot of investment, both in terms of talent and capital, into building the right applications that can actually make a big difference to the knowledge workers in terms of productivity. So we are starting that phase.
Last question here for us. I asked this of Mark Mahaney too, is what's the biggest misconception right now when it comes to AI and using it?
I think the biggest conception is, I think people tend to either underappreciate its capabilities or sometimes getting over optimistic. It's quite hard to get it right.
So it's like too much or too little?
Too much or too little. So I think most people are either under-hyping it or over-hyping it. It's very hard to get it right. But one thing is very obvious to us is that the pace of the change is unprecedented, and it's getting better. Like the DeepSeek just introduced, open sourced all their efficiency engineering tricks to the whole world, and then everybody is going to adopt it. So all of this is pushing the efficiency frontier. So we're getting better and faster every day. So people should be prepared for the big change.
All right, Ben, thanks a lot. We really appreciate it. Ben Ren, he's founder and CEO of SigTech. It's like a Goldilocks thing. It's like no one actually knows, so it's either going to change the universe or it's going to ruin it. Somewhere in between.
$350 billion of CapEx.
Yeah, wow. That is definitely not chump change.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix Steele, Paul Sweeney. We are live here at the Bloomberg Invest 2025 conference down here at Brookfield Place, formerly known as World Financial Center. I used to hang a shingle down here at Merrill Lynch back in the day, so some good memories here. I tell you, if I were to come back on the street, Alix, again, I'm telling you, private credit might be the place I go. I mean, I went to the Chase Manhattan Bank Credit Trading Program, the best on the street. I could go run circles around these guys. I should have done that. Mark Lipschultz joins us. He's co-CEO, Blue Owl Capital, speaking here at our conference here today. We appreciate getting a few minutes of your time, Mark. Talk to us about Blue Owl, how you guys fit into the private credit business, because Alix and I are just amazed at the funds that are flowing into that market.
Well, first I have to find out how to recruit you to join Blue Owl, because we're
Exactly.
looking for the best of the best at Blue Owl.
He's probably open. He's
Credit
open.
training.
It's all about the
open.
people.
It is.
And I also want to say it's great to be back down here. My first apartment in New York when I moved here in 1991 to work at Goldman Sachs when it was at 85 Broad Street, it's right down that street.
Me too. That's where Solomon Brothers put us up back in the day.
Ah.
So I could say I lived down here and had a water view and all that kind of stuff.
Lovely.
Talk to us about
Lovely.
private
Yes.
credit. You guys are just a part of just an amazing asset class.
Well, we've been very fortunate to be part of an asset class, and I play our role in helping evolve it. Look, private credit, to set the stage, right, is about taking long-term capital from investors, and we've tried to broaden the range of people that have access to it, and to be able to provide that capital to corporate users to support their growth with a view to the long term. And to be here on a day when the public market is so volatile, in some ways is very much a reminder of why private credit works for investors, but also why it's important. Because look, we're doing business today. We're making loans today, just like we were yesterday, just like we will tomorrow. Screen red or screen blue, or screen green. Prefer green.
Green. I should disclose that through my money manager, I do own shares in Blue Owl Private Credit.
Oh, thank
So
you.
I do have some of that. I feel like I need to say that.
Thank you.
But it's not
I
through me.
appreciate
It's
it.
through my money guy.
Okay.
So help me understand the competitive landscape, though, because it feels like banks now want to get a slice of the private credit market that they had to give up. And now we're seeing some partnerships with private credit shops. How do you look at it?
Yeah, the evolving landscape with the banks is pretty interesting. Let's make a couple observations. The word, like referencing the bank market, I think is worth unpacking a little bit, because as obviously you will know, when we go back to 30 years ago, I started in the private markets. The alternative market wasn't called that at the time. And we actually borrowed money from the banks when we were doing an LBO, as it was called then, literally from their balance sheets. That over the last 30 years has been on a long trajectory, changing from being a lender to now the banks don't lend to these companies at all. And that's been true for a while. They intermediate, right? They'll go in and they'll underwrite a loan and then sell it into the market, cut it into pieces and sell it. And so in that regard, of course, that's an alternative way to finance a business. And we could talk about the pluses and minuses of both. It's great to have both markets. You want to have a good, vibrant bank intermediated market. But remember, what the bank cares about is, can I underwrite the loan and sell it in the next 60 days? So the red screen today is dramatic for a decision for a bank to underwrite a loan. On the other hand, we're the exact opposite. It doesn't really matter to us what's happening in the market today. What matters to us is, do we get paid back 5, 6, 7 years from now? That's our decision. That's what we're focused on. So in that sense, we really live in kind of with different incentives and serve a different function. However, to the good point, the banks are saying, okay, but turns out private credit really does work, right? They spent a lot of time criticizing the market and trying different ways to maybe scare up the boogeyman. But now they, in fact, are actually launching funds to do private credit. So I'd start with, look, if you can't beat them, join them, and that's great. We'll take the endorsement of the market. It's a big world. Credit's a multi-trillion-dollar asset class, multi-trillion-dollar marketplace. We need vibrant, available capital, and having a bank launch a fund, great. There's a lot of funds in the world, and some of those will be done in partnerships, as you noted, and some will just be standalone efforts, and some will just continue to stay the course and do their traditional underwriting.
What's a typical deal for Blue Owl these days?
So a typical deal for us, and this has been true for us from the beginning. Now, obviously, the attributes and the size have changed. But over the last roughly 10 years that we've built Blue Owl, our reason to be was to come in and say, look, we want private credit to become the lender of first choice as opposed to the lender of last resort. And private credit, if you go back before that time, was really a lender of last resort. It's where you went if you couldn't get money from a mainstream source. As I said, I was at KKR for 21 years, and during that time, I don't recall ever working with a private lender. That just wasn't what you did if you were a mainstream borrower. But the idea for Blue Owl and today, so to answer this question, has been to create actually a real value proposition in having a partner to really work with, a long-dated capital pool for someone who has long-dated needs and long-dated ambitions with their business. So our typical company today, often backed by a private equity firm, a sponsor. Sometimes it's just private family-owned businesses or other corporate enterprises, but typically a private equity-backed business. And they're buying a very large company, and they're looking for a long-term partner to buy it. So typically when we do a transaction, we're lending maybe 40% of the purchase price, and the buyer is putting up 60% of the capital. So that's it's a very, very low leverage structure compared to what people are used to. If you go back again, 10 years and 20 years. And the company today, our average company in our portfolio has over $200 million of EBITDA. I mean, these are big companies today. And that's been a dramatic shift from 10 years ago when it was really a market for smaller businesses.
So let's get to that 5 to 7 year time horizon, because 10 years ago, that's the exact same conversation I'd be having with private equity, right? And then we see where things get tough and things get stickier when vintages don't work out or they come under different times of market stress. How does that apply to the credit space?
So I think it applies for sure in the sense that every market evolves and every market will have its maybe slightly higher and lower moments, but there's an important distinction.
Okay.
At the end of the day, private equity, if I kind of use this metaphor, private equity, which is a business I personally participated in for decades, is about mining for gold, right? It's about going out and maybe in our simplified parlance, you might call them the get-rich strategies. It's how do you go out there and shoot the moon on great returns? So they're mining for gold. Our business in private credit is to be the picks and shovels provider to those miners. So we're not trying to find a big gold vein. We're not betting on the price of gold. What we're saying is if the miners are active, and miners in this case would be any corporate user of capital, so they are always active, we want to supply them, and we take a less risky position, and we expect a corollary attractive return. So on the one hand, of course, every market evolves, and I don't want to suggest anybody lives in a vacuum, but the purpose of our strategies and the purpose of private credit from an investor's point of view is to have something that's much more about downside protection, stability, and income generation through times of uncertainty, which is a bit why I say this sort of red environment today is actually a good time to have the conversation, because what we're trying to build our portfolios and successfully have done over $100 billion of loans, and our running loss rate has been 11 basis points. And I think it speaks to the idea that this is about durability and predictability when times are uncertain. And I think it's probably safe to say today, everyone's looking around saying, gosh, it feels uncertain out there.
Mark, we got about a minute left. What do you say to those folks who say, as the business evolves, the dollars get bigger, regulation is needed? What do you say to those folks?
Well, we're a highly regulated business as is.
Okay.
So, today, look, we're regulated by the SEC. We're a public company as a manager. We have public vehicles. We have a lot of regulators we work with constructively. Happy to do it. I don't think if what we mean by more regulation is more direction from sort of a central source as to what you should or shouldn't lend money to. Remember, when we look back where the sources of problems have been, they actually tend to be in the regulated institutions, not outside, even recently. Of course, everyone remembers the financial crisis, but don't forget, over the last few years, as private credit has thrived, one of the moments we worked through was the run on the bank at Silicon Valley Bank.
Yep.
So, what's old is new. If you have one-day capital and you do long-term things with it, that's challenging. We have long-term capital to do long-term things. So I think at the end of the day, look, we don't touch depositors. We're not systemic. So it's a nice complement to a traditional banking market and a public marketplace.
Great stuff, Mark. Thank you so much for your time. Mark Lipschultz, Blue Owl Capital, co-CEO, talking about the private credit business and what a growth business it has been for sure.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.